So the agenda of this paper is really related to the recent developments dealing with the pattern of reserves to GDP. And let me motivate it by focusing, say, on China. But to a degree, China is really the largest hoarder of reserves, but similar patterns may apply to other countries. So what you see here at the top reddish curve is a pattern of reserve holding of China as a fraction of the GDP. And an obvious observation is that something happened around the crisis. And if you're looking beyond this window, looking at the present reserves, it's fair to say that there was a dramatic decline in the reserve position of China, reaching close to 50%. I believe it was 48% at the peak around the crisis, declining by 10%. So this is only one way to motivate the broader question. We know generically that the demand for reserves is unstable. And what we mean by the instability is debatable, but one minimal interpretation is that some variables that in the past didn't play a role suddenly are playing a role. So maybe it's instability, or maybe it's simply that variables that were characterized with zero volatility suddenly are highly volatile. And maybe there are institutional changes. So this is really the broad agenda of this paper. So our goal is to evaluate the role of variables that, to our judgment and knowledge, most of them had not been studied sufficiently before the crisis. We are asking first the stability of the factors accounting for the patterns of reserves before, during, and after the crisis. And then we're asking to what degree the crisis triggered structural changes. And we are concluding the paper with out-of-sample exercise, asking to what degree the countries that, in terms of our metric, seem to hold reserves below what the model is predicting forward are countries that, during the key events that evolved around the tapering talk of 2013, to what degree these countries that ended up, in our metric, holding reserves below the predicted value were exposed to larger depreciation, and the answer is yes. So of course, this is not a test of the model, but at least it's a confirmation that some of the predictive power is there. Having only 20 minutes, I'm sure that I'm not going to cover everything here. So let me point out that among the key results that we are identifying is that gross saving is associated with high reserves in developing and emerging markets, and this was before and after the crisis, and this effect is big. The opposite association holds for developing countries. Next, we find that swap agreements that really were triggered by the crisis are associated with, on balance, lower reserve positions. But again, the sample period is short. Everything deals with really the developments from 2008. So we are not sure what will be the long-run impact of swap agreements, because these agreements are typically for short durations, and the renewal is up to the discretion of the central bank that is the main provider of the swaps. Macroprudential policies complement reserve accumulation. Again, we are not sure how enduring it will be due to the reasons that I mentioned before. Now, sovereign wealth funds seem to be a coming major player, at least in some countries, and sovereign wealth funds are associated with lower international reserves. Again, I can discuss each of these findings more. We are not convinced that all these correlations will survive for the future, but this is what the data is telling us. Now, we find also negative impact of outward foreign direct investment on reserve accumulation in the pre-crisis sample. Now, this is consistent with the trend of diverting reserves into tangible foreign assets. And if you are focusing, say, on China as a motivator of this, we know that de facto there was reallocation of some of the reserves to the sovereign wealth of China that is using them, apparently, as far as we can judge, to fund part of the foreign direct investment in Africa and in Latin America and the like. And in a follow-up paper that I'm doing now, we are trying to focus on this Chinese aspect. But it seemed to be not only China. If you are looking at Latin America, and with Rera Citron, we did a recent paper on this, the same pattern applies. And this is in line with my paper with Grunien, which is somewhere in the room, that looking at the data, we found that emerging markets eased outflows more in response to higher stock price appreciation, higher appreciation of the exchange rate, and higher reserve to GDP, and higher real exchange rate volatility. And of course, this applies to several windows during the crisis and after. So these results seem to be in the data for beyond China. And I mentioned before that one confirmation, at least, of not violating the logic of the model is that when we are looking at the emerging markets with insufficient reserve holdings in 2012, they experienced on average exchange depreciation against the US dollar during the window of the tapering talks. And this is an important window, and with the paper with Michael Hutchison and Mahir Binchi, we noted there that reserves are definitely an important part of what characterizes the fragility of the five, or the fragility of emerging markets versus the non-fragile. So let me skip. There is a very long history and list of all the maybe 10, 12 potential forces that may shape accumulation of reserves. And this is only partial list. And the new factors that we are focusing here are dealing with outward FDI, the presence of sovereign wealth funds. And of course, some of these new factors are not new. They maybe are new in terms of the conditioning variables that we are focusing here. So sovereign wealth funds are almost as old as some of us in this room. But there is a growing trend of more and more countries to use them more proactively. Macroprudential policies and regulatory changes, swap agreements, and this is definitely a new variable. We know that swap agreements existed before, but it's fair to say that the global crisis initiated really a massive use of swap lines, unprecedented, and also to the surprise of some, China became a major player with swap lines, targeting mostly, but not exclusively, emerging markets. So this a new player seems to be among the most important developments, and time will tell the importance of this. Saving rates, commodity terms of trade volatility is not new, but definitely it's useful to pay attention to this in the context of reserves development. And then we asked to what degree the composition of exports, and more generally of the GDP pie, plays a role. And of course, we expect that commodity exporters are characterized by the unique challenges associated with the Dutch disease and comparable issues of excessive volatility, relative at least, if you are comparing the commodity terms of trade to manufacturing terms of trade. So we are trying to control here for the nature of the export composition being commodity-based, manufacturing-based, and the like. And then we are looking at financial exposure to gross flows and keeping up with the Joneses, or the chance, depending on the region that you are, which is really the possibility of strategic interaction between, say, China and Korea and Japan, whereas the attempt of China to mitigate the pressure that occasionally working towards the real appreciation of the currency may trigger maybe Korea and Japan and the like to behave in the same way. So in a nutshell, so in terms of the empirical analysis, we are somehow in an arbitrary way are dividing the variables into three categories. Traditional variables are going back to the literature of the 70s, 80s. At that time, financial openness was very limited. This was still the era of the age of the Bretton Woods system. So the story was mostly trade, propensity to trade openness, volatility of reserves holding, the opportunity cost of reserves, and the level of economic variables. and of economic development. Now, financial variables are inclusive of financial debt, say M2 over the GDP, net liabilities for FDI, debt, portfolio investment, de jure financial openness, and the like. Then we added variables that are more related to structure and maybe regimes, including exchange regime and geographic location and the like. And then we added a host of the new variables that I mentioned before, so let me skip the long list. And then the methodology, before jumping to the main results, is that on the left-hand side, we are looking mostly on reserves to GDP, and then we are controlling in the first round for the set of the three groups of variables that I mentioned before, in the first round of the regressions, and then we are adding the new variables. And we are focusing, if you wish, on three windows. The first is the age of the great moderation, at least taking the perspective of the OECD countries, 1999 to 2006. And then we are looking at the era of the crisis, 2007 to 2009. And then, subject to the data limitations, we are looking at 2010 to 12. And then we are looking at the results if we are looking at the entire sample from, if you wish, 1999 to the end. So let me point out that the big story is that if you are comparing the characteristics of the outcomes, then it's fair to say that we detect, and we are not the first, a lot of instability in the patterns of reserves during the window of the crisis, and this is obvious if you are thinking about the Lucas critique and the like. But then if you are looking at the period 1999 to 2006, and then 1999 to 2012, then we detect really that there is a sense of stability. The window of the crisis was only 2 years, so somehow it turned out to be a net wash when you are extending the sample period. Now, we don't think that there is anything like the optimal model, but statistically, we are going through a certain procedure that is trying to filter out what are the variables that are more robust. And here in a nutshell, you can see in the red font that you cannot read, all the new variables that new, at least in terms of our limited definition. And then it's fair to say that the results are consistent with the fact that some of the new variables are not new in the sense that ones that you are adding to the regressions, and maybe some of this was done before and we failed to detect it, so my apology to any author that we are not mentioning, but the main idea is that we detect that gross saving is of critical importance throughout all the windows. The Johnson's effects is also robust, though the 2 years of the crisis, nothing is behaving in the, or almost nothing is behaving the way that you would expect it, not knowing that this is a crisis. And then during the window of the crisis, it turned out that imports to the GDP played a pivotal role. All the other variables are less significant. Now, in the latest window, 2010 to 12, the new variables are significant: sovereign wealth funds, swap lines, savings, and the like. Now, I mentioned before that the out-of-sample exercise is delivering results that are consistent with our expectations. So let me only show you in one chart that here on the right, we are measuring the predicted reserves in 2012, and then on the vertical scale, the actual reserves in 2012. And then we can identify India and Indonesia as the countries where, if you are looking at the ray from the origin, these are the countries that are characterized by the flattest ray, and this is consistent with the proportionate largest deficiency of reserves relative to our benchmark. And then we are, so here, this is the ray characterizing India and Indonesia. And then looking at this exercise, we confirm that countries that in terms of this definition, were characterized with deficiency of reserves, were exposed on average more to the depreciation pressure around the window of the tapering talk. So let me, to be on time, let me run through the conclusions. There's no reason to expect any stability of the demand for reserves, and we don't expect this to be, of course, the end of the evolution. But the new factors, or the factors that were ignored before, may deserve much more attention. And if you're looking at the big picture, it's fair to say that prudential regulations are here to stay. So chances are that they will impact definitely the reserve coming forward. Now, if some of the demand for reserves, for example, is related to the attempt to hedge the exposure of a country to balance sheet generated by, say, borrowing in foreign currency by the private sector, then maybe prudential regulations that will mitigate this, if you wish, tendency may reduce the level of reserves. So again, looking forward, we don't expect the end of hoarding reserves. On the other hand, focusing on China, it's fair to say that if the future of China is greater willingness to use sovereign wealth fund and to liberalize outward FDI, so this is another factor that will impact down the road and is consistent with the decline of the reserve to GDP of China of 10%, and there is no reason for this to end up there. After all, if you're looking at China, it goes back to the issue that it's not self-evident why a country should load itself on inferior assets like reserves that are very safe, but in terms of the intermediate run evolution, they are providing, if you wish, quite a low real return for a country like China, especially if you are projecting the trend for the real appreciation of China for the coming 10, 20 years. And maybe it's smart to use these, if you wish, inferior assets in terms of the cost-benefit analysis in order to move towards deeper diversification into equity, foreign equity positions, and also outward FDI, which of course is the story of China as far as we can see now. So there is no end, but we believe that the growing importance of swap lines, outward FDI, sovereign wealth funds, and the like, may imply that at least there is some headwind that will reduce the reserve to GDP of some countries. But some may focus more on China. Time will tell, of course, what will happen in India. And I would like to end up, maybe, if I have a minute, to point out that, think about India. In a paper that I mentioned before with Daniel Riera-Citron, we pointed out that countries that are adopting inflation targeting frequently, after adopting the adaptation of the inflation targeting, there seemed to be lower willingness of the central bank really to commit to a policy of active, leaning against the wind and active management of the reserves. Now, in the context of Latin America, what happened is that there was a reallocation of the responsibility from the central bank to sovereign wealth funds. Now, of course, you can say that India don't have sovereign wealth fund. You may be right, but I'm not sure, because you can think about countries that are sitting on, if you wish, a negative sovereign wealth funds position as countries that are short in terms of assets in the sovereign wealth fund and long in terms of external debt. And then the results that we pushed in that paper, we believe are applicable for most of the inflation targeting countries. Once that you are adapting inflation targeting, you should expect a change dynamically in the role of reserves and maybe greater weight to add to the treasury or maybe sovereign wealth fund, which frequently is a branch that is quasi-independent in between the treasury and the central bank. And again, with all the, this is coming from the perspective of Latin America and maybe not viable for India, but definitely there's something in the formal decision of becoming inflation targeter that on balance is changing the attitude towards hoarding reserves. Thank you very much.
What the paper does, the motivation of the paper, as we all know that emerging market economies substantially increased reserve accumulation after the 1990s crisis. The main motives being precautionary, insurance, the mercantilist motive, or even keeping up with the Joneses. And that has been widely documented in the literature by one and many. After the global financial crisis, the macro landscape is back to being volatile again, emerging market economies being no exception, and they continue to hoard reserves. So what this paper tries to look at is what has been the impact of the global financial crisis on the patterns of international reserve hoarding. In particular, were some countries motivated to supplement reserve hoarding with other factors, or were other factors acting as substitutes for reserve hoarding post-global financial crisis? So the paper in a nutshell, it's a standard panel fixed effects regression is what they apply, supplemented with principal component analysis for developing and developed countries. They evaluate the stability of factors accounting for international reserve hoarding, splitting the sample into 3 specific subperiods: the pre-global financial crisis, during the crisis, and post-crisis. They also group the control variables in 3 distinct categories, most important being the third category of new or recently discussed factors, which include, amongst others, sovereign wealth funds, macroprudential policies, access to bilateral swap lines, gross savings, outward direct investment, export composition. And the reasons for each of these, Joshua explained it quite well, so I'm not going to go over them again. They also examine the adequacy of international reserve holdings for the 2010-12 post-crisis period, and using the models, they try to predict that whether there was under-hoarding or over-hoarding, and how this was connected with currency depreciation, especially during the 2012-13 period when the Fed started announcing or showing signs of QE tapering. The main findings of the paper, they find that the factors determining international reserves have indeed been evolving over time with developments in the global economy. While pre-global financial crisis, gross saving is associated with higher international reserves, they find that outward direct investment diverts assets away from the reserve account. During the crisis, however, the variables mostly become insignificant or have opposite signs. After the crisis, the new factors seem to dominate, is what the claim of the paper is, especially swap line, savings, ODI, and sovereign wealth funds. They also find that developed countries have very different motivations for holding reserves, perhaps because of their obvious different economic realities. They find the fragile 5 countries were under-hoarding reserves during the immediate post-crisis period, as a result of which they also experienced significant currency depreciation in 2012 and 13. So they find a negative correlation between currency depreciation and reserve overhoarding. So my comments first is with regards to the new variables, or the recently discussed variables as they call it. One is sovereign wealth funds. So out of the 73 developing countries, I wonder, if we keep the oil producers aside, how many are actually having sovereign wealth funds? And even if there are quite a few, the guess, or even what the authors mention in the sidelines in the paper, is there has to be a threshold effect in sovereign wealth fund. For instance, once the reserves reach a certain level, which is sufficient to cover the self-insurance needs, and then if the country has a high saving rate, they would feel the necessity or the need to invest in a sovereign wealth fund. So maybe it might be a better idea to estimate a threshold effect in international reserves, to see that it's not all countries for which sovereign wealth fund plays a role in reducing international reserves. And if saving rate is another indirect channel, so maybe interact the sovereign wealth fund with the saving rate, that only countries with high saving rate are the ones which have sovereign wealth fund, not all the reserve holding countries. Also, instead of using a sovereign wealth fund dummy, might be a better way to use the actual assets at the disposal of the sovereign wealth fund, to give an idea that how much is being siphoned away, or by how much are the reserves declining because of this particular variable. Again, with access to swap lines, I wonder again how many developing countries out of the 73 that they have in the sample had access to bilateral swap lines. I would think Brazil, Mexico, Korea, Philippines. So once again, only a certain type of countries were eligible or selected for swap lines. And I know Joshua himself has paper on this. So it's possible that countries which already had high reserves or current account surplus, or were already strong, were the ones who were given swap lines. So there's bound to be some kind of a possible endogeneity. and lagging variables by one period might not be a good way of controlling further endogeneity. Third, again, if swap lines are indeed reducing or mitigating the need for reserve hoarding, it's because of the opportunity cost of hoarding reserves. So why not interact the swap lines with the opportunity cost of reserves and see if that is actually the channel through which the substitution effect is operating. So just digging a little bit deeper into some of these results. With respect to ODI, again, there's a link between ODI and international reserves, which turns both positive and negative in the regression results. So is there any evidence from the literature establishing that there is a reason why ODI would be negatively related to international reserves? And even with ODI, I would think there is bound to be a threshold effect. For example, China, who has the maximum amount of international reserves, can afford to not hoard reserves and instead go for ODI, but maybe not Philippines or Thailand. So again, all 73 developing countries may not be affected in the same way by these variables. Results for the developing countries focused on this particular group because that seems more important with respect to reserves. Post-global financial crisis, they say the new factors are dominating the results, but there are a bunch of new factors, for example, commodity volatility, terms of trade, macroprudential measures, export composition, which come out to be insignificant statistically. Sovereign wealth fund, there's a lot of sign changing that's happening. The sign changes between the post-GFC and the full sample. ODI, there's a different sign between pre-GFC and post-GFC. So when I was reading the paper, my feeling was I could understand that why new variables might become significant after the global financial crisis, because it's a watershed event for all countries. But why were the variables changing signs after the crisis? So that led me to question, is there anything specific about the post-global financial crisis as a result of which this was happening? And that doesn't come out very well in the paper. So are these results driven by the structural changes happening in the global environment, or are these driven by just a handful of few countries? Or are they just sporadic factors which are just a result of those few years? Again, when I look at the traditional macro factors, for example, financial exposure has a different sign post-global financial crisis compared to the full sample. Again, during the crisis, the opportunity cost of reserve seems to be increasing the reserve holding, which I found quite counterintuitive. There's not much of an explanation of this in the paper either. Macroprudential policies, one of the new factors mentioned in the paper, have a positive effect on international reserves, which I would think is counterintuitive, because if the macroprudential measures are effective in stopping volatile capital inflows or hot money flows, then the need for hoarding reserves should go down, if anything. But the only time it's significant is the overall sample period, which is when it's positively related to reserves. And I'm not sure why. So the paper doesn't give any explanation for the results of the GFC, the crisis period, saying that the markets were volatile, and that's about it, but not exactly why the signs were changing so much. Instead of simply dividing the sub-periods, maybe something specific about the crisis, let's say interacting with the market volatility index, or something specific about the structural changes in the global environment that were driving the results. I think that would be very helpful. Also, instead of arbitrarily dividing the sample into global financial crisis, which I understand is a first cut, that's what I guess all of us would do. But as a next step, maybe why not formally test for structural breaks in the reserve series and see if that actually coincides with the global financial crisis. That would make it more formal, so to speak. One minor comment about the econometrics is why not look at change in international reserves and GDP instead of the level, because we're talking about the dynamic evolution of the determinants. Post-GFC, Joshua himself mentions two smaller sample period, maybe a few years later, this will be an even more interesting exercise to perform. And that's why the post-global financial crisis model they have is very weak. The R-square is only 0.01, and it's also very weak for the prediction exercise that they do later on, as a result of which they use the pre-crisis model for doing the prediction. Maybe it might be interesting to not include the countries which had sovereign wealth fund or access to swap lines, and for the other bulk of developing countries, see what are the factors that became important after the crisis. So that would show that whether these countries are driving these results. Again, one thing that I just thought of is, let's say when there was renewed capital inflows in the 2010 after the global financial crisis, some countries like India, Malaysia, Chile, and Colombia, they absorb the capital inflows not through reserves, but they let the currencies appreciate. Whereas some countries like Korea and Peru increase the reserves. So is it possible that the whole trilemma configuration is changing as more and more developing countries move towards greater exchange rate flexibility and retain monetary autonomy because of inflation targeting or whatever reason, reserve as a whole is declining for developing countries. So that's something that didn't come out from the paper. Overall, I think it was very interesting and insightful analysis, and the authors have done a very thorough job of doing principal component analysis and some robustness checks to bring into light some less discussed factors which might determine international reserve hoarding patterns, throwing light that how international reserve accumulation is a dynamic process which keeps changing if there is a massive crisis event. The important policy implication is the new factors might mitigate reserve accumulation, and this definitely can be researched much more going forward, maybe with a longer sample period. And it also points towards a possible regime switch in reserve accumulation, which can be tested much more formally instead of just dividing the sample into different subperiods. So that's all. Thank you.